Well, hi everyone, and welcome to the Buffett and Beyond Research Stock of the Week. And the question is, would you rather have Arthur Gallagher, AJG, or BlackRock in your portfolio? And folks, I'll tell you right now, they're in the financial services field, and they are both good companies. And remember, folks, if you want to live on this beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. And let's look at these two companies. Well, they're both in the financial services business, and Arthur J. Gallagher and Company provides insurance, brokerage, risk management, employee benefit services to a wide variety of commercial, industrial, institutional, governmental organizations, and 250 offices in 7 countries. Now, BlackRock is one of the world's largest publicly traded investment management firms and manages assets on behalf of institutions and individuals worldwide. And these definitions go on, but you can see they're similar companies in one way, in that they're in the financial services business. So let us look at the numbers of these companies. And the first thing we want to look at, and of course over here is the year. So we're looking at BlackRock up here, and we're looking at AJG, and we'll call it Arthur Gallagher because AJG is difficult to keep saying all the time. And the first thing we look at is the clean surplus return on equity. Now, this return on equity is different than the traditional accounting return on equity. But think of your bank account. Would you rather put your money in a stock that is giving you 20% a year? Yeah, I would. Or would you rather put your money in a company that's giving you 24% a year? Well, even better. So we're looking at the average stock in the S&P 500 has about a 13.5% clean surplus return on equity. So the theory of clean surplus is that stocks with higher clean surplus return on equity will outperform stocks with lower clean surplus ROEs. And if you divide the investment stocks into 2 groups, the first group has a higher return on equity than the average stock, higher than 13.5%, you'll outperform the S&P 500. If you have stocks in your portfolio that have lower than 13.5% return on equity, you'll underperform the S&P 500. And I'll tell you, we've done a lot of analysis of portfolios out there when we had our radio program for several years, which was very, very successful. Folks, you all had good stocks in your portfolio. The problem is you all had stocks that were below average stocks in your portfolio. And I mean, that was almost to a portfolio, to a T. You all had good stocks, and you all had stocks that, gee, we grew up with, and they sounded good, and they've been good to us, but they're not as good as the average stock any longer. So that's what you have to look at. You have to be able to look at the clean surplus return on equity. That's why we have a computer program that does this for us. Now, so we're looking at AJG, Arthur Gallagher, and we would think that this stock will outperform the S&P 500 and will outperform BlackRock over time. Now, let's go over here to retention rate. Retention rate is how much of the money a company is making is it putting back in, is it retaining and putting it back into itself in order to grow. BlackRock with about a 50%, 51%, and Arthur Gallagher with 59%. So Arthur Gallagher seems to be, not seems, but is putting more of what it makes back into itself in order to grow. Now, let's come all the way over here for a minute and realize one thing. The market cap of BlackRock is double that of AJG. So therefore, BlackRock is a larger company. So if it's putting 50% of its money it's making back into the company, it's still putting more money into itself than is Arthur Gallagher. But Arthur Gallagher has room to grow. And how do we know that it's using its money efficiently in order to grow? We go back to the clean surplus return on equity, a high clean surplus return on equity, and it's putting money back into itself in order to grow, and it's investing it at or reinvesting it at a nice high return on equity. And that's what we look at. All right, let's go to net income growth. And net income growth is the income. It's not traditional accounting earnings. It is clean surplus earnings. It's the earnings from the core operations of the business. Think about McDonald's. Is McDonald's a burger place or is it a real estate company? Because it owns a lot of real estate, folks. So if it sells off some of the real estate to its franchisees and that goes on the income statement, that shows up as profit. But really, when we compare McDonald's, we compare it to Wendy's, we compare it to Burger King. So we want to know the real income from the core operations of the company. And we can see that Arthur Gallagher is double that of BlackRock, so its net income growth is double BlackRock. So that's very, very good. Now, when we get, and the average stock out there is about maybe 13% net income growth for 2025. So Arthur Gallagher is an above average company in this stage or in this area where BlackRock is not, if it's underperforming. Revenue growth about 7% for the average stock out there. So BlackRock is a little bit over the average stock, which is good. And Arthur Gallagher at 9.2% is about 20% better than the average stock out there. So that's even better than BlackRock. Now, years to pay debt. This is Buffett's rule of thumb. He says if a company takes all the money that it's making and uses it just to pay off the debt, how many years would it take to pay off its debt? His rule of thumb is 5 or less. Ours is 3 or less, so BlackRock certainly fits the bill there. But when we get down to Gallagher, we're looking at 5 years to pay debt. That's within Buffett's parameters, not ours so much. But when we look at the revenue growth and we look at the net income growth above average and we look at this return on equity, if we're going to have one of these two stocks, we would probably go with Arthur Gallagher. In fact, we have. So let's look at 1 year and how these stocks have performed relative to the S&P. S&P is the black line. And by the way, in the past year, the S&P has returned 25%, which is phenomenal. Usually we're looking at 7% when you account for inflation. If you're not accounting for inflation, you're looking at about a 9.8% growth rate over the past 22 years. So 25% is really phenomenal. So when you think of an average of 9.8% growth over the past 22 years, and then all of a sudden you come up with almost 3 times that amount. Problem is that something like 75% of the growth of the S&P was in those 7 mag stocks, the Magnificent Seven, as they call them. And you all know them. It's Apple, it's Google, it's Meta, it's Tesla, it's Nvidia. So those are the stocks that really propelled the S&P. So if you kept up with the S&P over the past year, you actually did pretty good, because the S&P is not the average stock out there, and the average stock in the S&P was down about 7 or 8%. Last time I looked at it, folks, without the Mag 7. So here we go, an exceptional year. Both these stocks, blue line is BlackRock, yellow line is Gallagher. So both stocks kept pace with the S&P 500. Both did very well this past 1 year. Now, when we look at 5 years, we look at the S&P, black line, and we're looking at BlackRock, the blue line, and Gallagher, almost 2.5 or more than 2.5 times both BlackRock and both the S&P 500. So look at this beautiful growth rate it has in here. Nice and steady. Boy, we love that. Now, I want to show you one thing. This is 2022. 2022 was a down year for the S&P. S&P was down 19.6%. The NASDAQ was down 34%. And we can see BlackRock fell quite a bit, more than the S&P 500. But what did Gallagher do? Gallagher actually grew in this down year of 2022. So Gallagher was a good defensive stock to have in your portfolio. And that's why we like it. It's a good growth stock and it's a good defensive stock, or at least it has been in the past. So we like that. Now let's throw in here financial ETF, and this is the XLF over here, XLF, and that's the S&P Finance ETF. Again, black line S&P 500, blue line BlackRock, and down here the financial, or the S&P Financial ETF, underperformed both BlackRock and the S&P 500, and of course Gallagher is all the way up here. So the point I'm bringing out is that both Gallagher and BlackRock outperformed the ETF, or the financial ETF, and they both outperformed the S&P 500, BlackRock by just a touch and Gallagher by a long shot. So folks, do we have Gallagher in our growth portfolio? Yes, we do. Do we have BlackRock? No, because BlackRock is performing as well as the S&P 500. And if we're going to take a chance, we would like to reduce our risk. We would rather invest in the S&P 500 than BlackRock, because the S&P 500 is diversified among, 500 stocks. So yes, Gallagher, we like. Both of these are good stocks. BlackRock is a good stock, but it's not as good as the stocks that we put in our portfolio, because if you can't outperform the S&P 500, you invest in the S&P 500. If you could outperform the S&P 500, like we have over the past 22 years, 2.5 times more than the S&P 500 on a compounded basis. So therefore, we're looking for stocks that outperform the S&P 500. So folks, we had a pretty good week this past week. We had a pretty good year in 2024, and so far 2025 is up in the air right now, but we just came off a good rally this past week. So go out, walk on the beach, walk on the golf course, go snowshoeing, go skiing, and be with your family, sit in front of the fireplace. In other words, enjoy yourself. Take your mind off the market, because it'll be opened again this coming week. It's closed on Monday for the inauguration, and after that, we'll be back with you in a few days. So folks, stay safe. We'll see you next time.